Viewers, this is the video on the continuation of how to prepare cash flow statement. So I've already made the first part. The first part talks about the direct method, and in this current video I'm going to talk about the indirect method, which is the easiest one or the simpler method. So the difference between the two methods lies in the operating activities. They have different approaches of preparing the operating activities. So I'm going to show you how they all work. So the indirect method simply, but first of all, in case you haven't watched the first video, the link to the first video is in the comment section of this particular video. I've already explained a lot about cash flow statement in that particular video, so kindly watch. So in this particular video I'm just going straight forward. So the indirect method, it deals with two principles in preparing or in handling the operating activities. So it tells you that if an asset, so if a current asset has increased, for instance, at the left here is my balance sheet, as you can see. So if under the current asset I have here debtors, so as you can see the point at debtors. So the indirect method is telling you that as the debtors 2019 the figure was 45,000, then 2020 the figure was 48,000. So the difference, which is 3,000, the indirect method is telling you that if you go to the cash flow statement, subtract that difference, put it in bracket. Why? The assumption may be simple. Maybe the organization gain that asset increment or the extra asset that's there, which is the 3,000. The assumption is that the organization gain that asset by using money to purchase for it. So you subtract the amount. That's the assumption. Likewise, if the current asset has reduced, as we can see here in the case of pre-operating expenses, in the current asset here, it has reduced. 2019 it was 3,000, 2020 it's now 2,000. So if it has reduced, the difference, so in this case we have 1,000. So the difference, we are going to add it. It is assumed that the organization sold that particular asset and received money. That's the assumption. Then you then move to the current liabilities. So here is the opposite. So the current liabilities, when the current liabilities has reduced, as we can see down here, follow the pointer. So the current liabilities, accounts payable, it has reduced. 2019 it was 25,000, 2020 it is 10,000. It has reduced from 25,000 to 10,000. The indirect method will tell you that the difference, which is 15,000, subtract it. Why? The assumption is that the 25,000 was a liability. So if it has reduced by 15,000, it means that the organization paid money for it. So you have to subtract that amount. It is very simple. I will show you how to do it easily. So likewise, if the current liability has increased, you have to add it. So the assumption is that maybe the firm has taken money from somewhere to support its activity, so cash is coming in. So there are two. When it comes to the current asset, if the asset is increasing, subtract the difference. If the asset is reducing, add the difference. And when it comes to current liabilities, when the current liability is increasing, add the increment or add the difference. And if the current liability is reducing, subtract the difference. So it's the opposite of what is under the current asset. So the indirect method simply look at add back of non-cash items. What do I mean by non-cash items? Items that do not involve cash, like depreciation, loss on disposal of equipment, and all those stuff. They were not cash-based expenses. For instance, depreciation, as you can see in the income statement, this depreciation was subtracted before getting the operating profit or the net profit. But that depreciation is not a cash item. So we need to add it back before we can know the actual cash. So even though we say depreciation we subtract it, but it's not a cash item. And other items too, sometimes we sell goods on credit, we don't receive the money. So we need to add all those things back. That's what the indirect method is looking at. So let me show you how that one works. And one simple thing you need to note is that the indirect method, it starts with the net operating income before tax. The net operating income before tax. That's what this one starts with. Some people start with the net income after tax. But here I'm going to start with the net operating income before tax so that the tax element will show. So this is where you need to start from. But the direct method, we start from the cash received from customers. But the indirect, we start from the net operating profit. And to this one, we add all non-cash items that were deducted before arriving at this net operating profit. So let's move to the Excel to demonstrate. So here is the format for preparing the cash flow statement. I've explained this in the first video. So I'll move to sheet 2. So here I have my operating activities, which is the start. The first one is operating activities. I've explained in the first video the 3 parts of the cash flow statement. This is why it is very necessary that you have to watch the first video. So I have net profit, so net operating profit, not just net profit, net operating profit before tax. So the net operating profit before tax, let's look at our income statement. How much was that? 27,000. So we have the net operating profit before tax being 27,000. So 27,000. So to that we now add back non-cash items. So let's move and look at our income statement. What are the non-cash items that were included? So first of all, I can see depreciation. Depreciation is a non-cash item that was subtracted before getting the operating income. So we are going to add back depreciation. So depreciation, how much was depreciation? 4,000. So we have add depreciation. Add depreciation, because depreciation is a non-cash item. So when we add depreciation, how much was the depreciation? The depreciation was 4,000. So we add the depreciation back, 4,000. So that is that for the depreciation. So do we have any other non-cash item? If there's any other non-cash item, we need to add it back. Is there any non-cash item in the income statement? No, there's no non-cash item in the income statement. So here we are done with the non-cash items. And likewise, if there were any non-cash items that was added, that one too, we would have to subtract it. So here we have no such thing again apart from the depreciation. So we then move to the balance sheet and also look at the difference in current assets and then current liabilities. So let's look at our current asset here it starts with our cash and cash equivalent, but we don't include this one. That's what we are trying to find. So we move to our debtors. So as the next asset, has it increased? Yes, 2020 it was 45,000, 2020, sorry, 2019 it was 45,000, 2020 is now 48,000. So it has increased by 3,000. So we move to our income statement, and then this is how you do it. So we move to our cash flow. So increase in debtors, since it is an increment, we are going to put it in bracket or subtract it. So 3,000. So increase in debtors. That's how you do it. Then the next one, let's look at the balance sheet. What's the next one? The next one is inventories. Has it increased? Okay, so inventory for 2019 was 3,000, 2020 was 4,000. So it has increased by 1,000. 1,000. So increase in inventories. Increase in inventories. So it has increased by 1,000. So that one too, we subtract. Then we move to the next current asset. The next current asset pre-operating expenses or prepaid expenses. Oh wait, it has reduced. So 2019 it was 3,000, 2020 it has reduced to 2,000. So by 1,000. So that one, since it's a reduction, we add it. So we add that one. So we have reduction in pre-operating expenses. So that one is a deduction, so we add it. 1,000. So then any other item in the balance sheet? Oh, no other item in the under the current assets. So let's look at the current liabilities. Current liabilities down here. What are we looking at? We have account payable. Has it reduced or increased? So account payable for 2019 was 25,000. For 2020 it has reduced to 10,000. So we are looking at the difference. The difference is 15,000. So this one is a liability, and the reduction means the firm is paying for those items. So we are going to subtract the difference. So we have reduction is in account payable. Reduction in account payable. And that one is 15,000. Then let's look at the next. The next current liabilities, income tax payable. Income tax payable. Okay, here because so here because we want the income tax to show, so we will not indicate the income tax payable. Else we will just indicate the increase in income tax, which is the difference between the 10,000 and then the 6,000. Then we will get our 4,000 and then subtract from it. If we were to start with the income after tax, we would have just have the difference, which is 10,000 minus 4,000. Then we will add it back, and then we move on. But here we start with the income before tax. So we need to do control account and know how much money was paid for the income tax. I repeat again, if we were to start with income as here income tax. So we have net income. If we were to start with this income, that's income after tax, we would have applied the same procedure to the one here. We would have just subtracted the difference between the 10,000 and then there was 6,000, then we will add it. But here, since it's an income tax, and the income tax is not an operating activities, that is why we are not doing it like that. The income tax is being imposed on the firm after it is done producing and then selling. So it's not an operating activities. So we are going to do a little bit of control account, which we were doing in the direct method. So it is very simple, or we can choose not to do that. So we have, let's just do it. So we have income tax, control account. So when it comes to the income tax, we are just looking at, let's say, the opening, balance for the income tax, which was 6,000. The opening balance for the income tax was 6,000. Then let's look at during the year, how much was the income tax expense? The income tax, as for the income statement, the income tax here is 6,000 at the bottom here. 6,000. So the new charges, new income tax charges. So income tax, the new income tax charge is 6,000. Yes, so have you paid any money out of it? Have you paid any amount? We do not know. So we have cash paid. Cash paid. So the cash paid, we then subtract it from that one. Then what is the closing balance for the income tax charges in the income statement? Income tax charges for 2019 it was 6,000. For 2020 it was 10,000. So we have the closing balance being 10,000. So 10,000. So if you find for the unknown, which is x, it will be 6,000 plus 6,000 minus x equal to 10,000, and you see that the difference is 2,000. So it means that the income tax actually paid was 2,000. But since the income tax is not an operating activity, we will have to sum these operating activities before we bring in the income tax that was paid. So here we are done with the operating activities, and then the net operating activities as we have gotten here is 13,000. Before we are now coming to look at the income tax that was subtracted or that was paid. So income tax payment was actually 2,000. So if you start with the net operating profit, that's the final operating profit. In that case, it means that for the income tax, we are not going to do this control account. What you would have done is that the difference, which is the 4,000, you would have added to this one as I've indicated here, without doing the control account. But here I've started with the net operating profit before the tax. So I need to do the control account to know the actual amount that was paid for the tax. So I'll add these two to get my net flow from operating. So I'll add the income tax payment, or I'll subtract it from the first one, and that will give me my net flow. So actually here is my net flow from operation, or better still, I can decide to write it here. So net flow from operating activities. Yeah, I'll just use the border to underline it. Yeah, so regardless of the approach that you use, whether you use the direct method or the indirect method, you have the same closing balance for the net operating activities. So then we move to the next segment, which is the investing activities. The investing activities, have they purchased any equipment? So here the investing activities is the same as the direct method. So it is the investing and financing activities. The approach for getting the figures is the same for the direct method and then the indirect method. So the investing activity, we are looking at whether the organization purchased an equipment, or whether they have sold an equipment and received money, or whether they have invested elsewhere. So what are we looking at? So because I've already solved it under the direct method, I know that the firm hasn't purchased any fixed asset or any equipment, else we would have written it there. But when you go to the income statement, after the income statement, there's a footnote down here. Let me highlight it for you. Equipment with net book value of 15,000 and original cost of 21,000 was sold for 15,000. So here our interest under the investing activities, we are looking at whether the firm purchased an equipment, how much it purchased it, or whether the firm sold an equipment and how much it received for selling it. So here they told us that the equipment was having 15,000 as a net book value, and then its original cost was 21,000, but it was sold and they received 15,000. So it's the 15,000 that is our concern. I've elaborated more on this one under the direct method. So I'll just go back to my investing activities, then there. So sorry. So I'll write proceeds from disposal of equipment. So the amount that they receive, how much? They say it was sold for 15,000. So since it's a money coming inside, 15,000. Then any other investing activities, or have they purchased any equipment? No, there is no indication like that. There's nothing indicating that they have purchased equipment from the balance sheet. So let's move to the income statement and see if there's any other investment item, whether the firm has invested money elsewhere or the firm has received money from other investments. Yes, there's something here, investment income. This one is not an operating activity, so the investment income, which is 4,000, so we need to add the investment income under the investing activities. So we move to the investing activities again, then we look at investment income. I've done all these ones under the direct method, since they are the direct method for the investing activities. The direct method is the same as the indirect method. So these are the only two investing activities. So you just sum the two of them, then you get the net flow from investing activities. Yeah, so what is left now is the last segment, which is the financing activities. The financing activities. So we are looking at financing activities, whether the firm has taken loan, whether they have paid dividend, or whether the organization has received additional capital from its owners. So where will we find the financing activities? The financing activities are under the capital and long-term liabilities. So the sections are very simple. The operating activities, you find it under the current asset and current liabilities. The investing, you mostly find it under the fixed assets, and then sometimes the income statement. For the operating, to sometimes the income statement. Then when it comes to financing activities, you see it under the capital or equity and the liability, the long-term liabilities. So let's look at our long-term liabilities. Have there been changes in capital? So we take it from the equity side here. So capital is the same. Retained earnings, okay, we will look at that. Long-term liabilities, 0. So there is nothing there. So actually, what we are looking at, we are going to look at these three items for the investing activities: the long-term liability, the retained earnings, and then the stated capital. So the stated capital, there is no change. It was 13,000 for 2019 and 13,000 for 2020. For the long-term liabilities too, there is no change, 0. Where there is a change is a retained earnings. So we need to analyze and get the actual money that was actually paid or received through that segment. So the only financing activity that we get here is the retained earnings. So retained earnings, we need to do some control account. Retained earnings are actually, we are looking at the profit that they make. They invest it in the business. So if in the year 2020 the firm made a profit of 25,000, as you can see, they made a profit of 25,000, and from the balance sheet you can see that the previous year the retained earning for the previous year was 42,000, as you can see here. So if they have added that 25,000, it would have been something like 67,000. But on the contrary, we have 41,000 as the retained earnings. So probably it may be that they pay dividend. So the difference will be dividend payment. So we are going to do the control account to know how much was paid for dividend. So we have retained earning control account. So the retained earning control account, so we have the opening balance, which was 42,000, I've done it already under the direct method, so the figures are fresh in my mind. So then we have the new profit. The new profit from the income statement is 25,000. You add a profit to it. So if the previous profit that was retained was 42,000, then this year you made a profit of 25,000. You should be having something like 67,000. But likewise, they were having closing balance for the retained earning. The closing balance is rather 41,000. So what happened? The difference is the cash paid for dividend. So the difference, cash paid for dividend. The cash paid for dividend, so we just indicate it in X. So how much cash was paid for dividend? So by my calculator, if you do it, will be 42,000 plus 25,000 minus X equal 41,000. So if you do it by my calculator, the dividend that was paid was 26,000. So 26,000 was paid for dividend. So you move to your financing activities. So then you have cash paid for dividend. Cash paid for dividend. So we have 26,000. So since there's no other investment activity, so all that you need to do is now to get the net cash flow. How much is the net cash flow? The net cash flow is a summation of the net cash flow is a summation of the net flow from operating, the net flow from financing, and then the net flow from investing. So now I'm going to add those net flows to get our total net flow, as I've already done under the direct method. So I will add this one, then I will also add this one, and in addition I'll add the last one. Then that will give me my net cash flow, which is 4,000. So 4,000 is my net cash flow. So to this 4,000, I'll add my opening cash balance. What do I mean by my opening cash balance? The opening cash balance, we are trying to confirm from the balance sheet. How come this 2,000? So let me scroll up for you to see it clear. Yes, so under the current asset, we have cash and cash equivalent. So we have 2,000 at 2019, then 2020 is 6,000. So we are trying to know where the profit went, the profit of 25,000 that was made. So the opening cash and cash equivalent is the 2,000 cedis here. So I'll then move back to summarize my table. So I have opening cash and cash equivalent. And how much is that? That one was 2,000. So we are trying to see if we do everything and then add it, whether we will get the closing cash and cash equivalent. Closing cash so let's check how much was the closing cash and cash equivalent for the year 2020. in the current, okay, it's 6,000. If we add what we are getting here, are we having the 6,000? Oh yes, we should be getting 6,000. So I'll just sum it. Yes, so yeah, so we have our 6,000 intact there. So here ends the direct method. Very simple. So all that I'm left to do is to underline it. Actually, different questions also come with different approaches, but basically this is the idea for preparing the cash flow statement using the indirect method. So if you couldn't get the closing cash and cash equivalent, then it means that something is wrong somewhere, or what you are doing is not right. So you have to cross check and then be sure. Yeah, in case you watch this video and you have questions, do not hesitate to ask them in the comment section, and then I'll gladly respond to them for you. And also remember to like the video and subscribe to this channel for more videos. Thank you very much.